So the war in Iran certainly introduces a new risk or uncertainty into our base case assumptions for the economy, the outlook over the year ahead. I would say, if anything, it widens the range of potential outcomes, both the negative and the positive, around our central scenario. And the key reason for that is that Iran is just such a key supplier of energy to the globe. And so if the conflict in Iran extends for a long period of time, it has important implications for the price of oil, which then affects inflation and perhaps consumer spending, and ultimately could weigh on economic growth more broadly. Of course, at the time of this filming, a lot of questions remain unclear. We don't know whether or not this conflict will escalate even further, or whether it will be short-lived or extend for a long period of time. And so what I like to do is look back at history and ask ourselves the question, well, what have financial markets done in instances in the past where we've had sort of a intensification of geopolitical conflict? And what we find is that typically the market response to these kind of events or military action tends to be fairly muted and often short-lived. So we've looked at events all the way back to World War II. For our data set, we've got 42 events in that data set, and on median, the S&P 500 has declined just around 3% over the course of 5 days, and has fully recovered within 12 days from the event. So, most of the time the impact is actually not all that significant, and the current experience, at least so far, is not all that atypical relative to that median experience. And so, of course, headlines will dominate the news flow in the near term, and perhaps cause a lot more financial market volatility and will potentially stoke fear among investors. But I think it's also important not to lose sight of the fact that ultimately this situation will likely come to a conclusion. Of course, we don't know when that will be or what that might look like. But at some point, investors, this situation will diminish, perhaps conclude, perhaps end. And then at that point, investors will likely shift their attention to things that are more important for the long-term outlook for the macroeconomy, which at the moment appear fairly constructive. We've got tailwinds from artificial intelligence. We've got central banks that have been easing monetary policy, and governments that have been expanding fiscal stimulus. So all of those things combined, aside from the situation in Iran, paint a pretty favorable or constructive macroeconomic backdrop.